Next on our list, and we're working in a downwards direction with regard to market cap. So we always do the big stocks at the front and the smaller ones as we go along, is Adapt IT, which is another one of these IT application solution providers, operates across different industries, has software that it rolls out, but really it's about applying software solutions, often IP of others, doing system integration and stitching it all together so that businesses can be more productive and efficient. The founder here was Sbu Shabalala. And remember, this one was the old Infowave listing. It was one of those cases where back in the day companies used to use sort of defunct quiet listings of companies that were almost evaporated as a quick route to the market. Market capitalization 1.6 billion rand. Impressive growth, very impressive growth. We'll see the chart in a minute. Price to earnings ratio 22.17. Dividend yield of 0.95. People tend to call this one the sort of mini EOH.
They do.
Because they like the idea that it's sort of got the same business model of buying its way into different industries.
Very similar business model, and of course still in the small cap space. So, I mean, a market cap of 1.8, and the market is hoping that they can continue using the same model EOH used in acquiring businesses and bolting that on to the existing client base.
Because for the uninitiated, the way that model works is that the listed entity has got a price to earnings ratio of 22, like we saw. But in the business of buying businesses from private owners, you can often buy them for sort of 5, 6, 7, 8, 9, 10 PE.
That's it.
The minute you bring those earnings in, it makes the bigger mothership then get a nice boost because that makes a better contribution. And so when they report their numbers, you see these like 30, 40, 50, 60, 70% earnings growth, and then everybody gets totally excited again. And like you said earlier, often the people who sold the businesses were paid in part using shares. So then they're like, hey man, this is Christmas.
It's a very good deal structure, and we'll see that reflected in the share price.
But it only works as long as it works, and there's a sort of a rise. If they stumble, these models can unfortunately unwind quite quickly.
Sure, especially if you do it in a big deal. But if you continue to do smaller deals,
it's
earnings accretive.
More manageable. Anything specific about the company? I mean, I see they're operational in education sector, in mining, financial services, bit of everything.
So the market was a little bit concerned because they had some exposure to oil and gas and the energy sector. So it's about 10% of the revenue.
Yeah.
So the market was a little bit concerned about that, but overall also quite a nice diversified client base.
Let's look at what that reflected like when you saw the share chart, because the share chart gives you a lot of information, because over time you can see how well it's done. And then a little bit, look, it has been a tough market across the board. Just generally people have been a bit scared since the tail end of 2015 about equities. So taking money off the table, this one perhaps doesn't have the great liquidity.
That's right, and we've also seen some director dealings. So 3 directors
buying,
selling quite substantial stakes. And the market is also expecting a BE deal to go through probably in the second half of 2016.
What, like a follow-on transaction? Because Mr. Shabalala's got a sizable stake here. This is one of their key selling points, is that they are a new kid on the block and they deserve to be supported. So that's a help for them when they get the corporate work.
That's right, so they're level 2 BE, but I think they are looking at about a 400 million rand BE deal that could lead to some dilution. So I think that, and then also the directors' dealings is really playing on a couple of people's minds.
So you're going to call it?
I'm definitely hot on this one, Paul.
Definitely hot still on it. Okay, good. I'll follow you on that one.